Friday morning is going to matter for silver, and most people watching this market right now are focused entirely on the wrong things. They are watching oil prices tick up and down, they are refreshing their Iran news feeds, they are waiting for the next tweet from Trump. All of that is real, all of that moves silver, but this Friday, the University of Michigan drops its preliminary April consumer sentiment reading, and inside that number is one specific data point that the silver market is going to react to more violently than anything else this week. It is not the headline sentiment number, it is the inflation expectations buried inside it, and once I show you exactly how this works and what it means for silver right now, you will understand why Friday morning at 10 a.m. Eastern is one of the most important moments of this entire week for precious metals. Let's get into it. First, let me give you the context you need. The University of Michigan Consumer Sentiment Survey comes out twice a month, a preliminary reading and a final reading. Friday, April 11th is the preliminary April reading. Think of it as a first snapshot of how American consumers are feeling right now in real time in April 2026. The March final reading came in at 53.3. To understand how low that is, the long-run average for this survey going back over 70 years is around 83 to 86. A reading of 53.3 puts consumer sentiment at levels near the all-time low of 50 that was hit in June 2022 at the absolute peak of post-pandemic. Inflation. Americans are not feeling good, and this matters enormously for silver because of the two inflation numbers buried inside the sentiment data. Here is the specific number that makes silver move hard on Michigan sentiment release days, not the headline, the one-year inflation expectations figure. In March, that number came in at 3.8%. That was the largest single-month jump in year-ahead inflation expectations since April 2025, before the Iran conflict. Started in late February, inflation expectations had been cooling. People thought inflation was getting better. Then oil spiked above $100, gas prices surged toward $4 a gallon nationally, and suddenly households started expecting inflation to get significantly worse in the next 12 months. That shift from cooling to reheating inflation expectations is the data point that is driving the Federal Reserve's entire decision-making process right now, and it is what silver holders need to watch most closely when Friday's number drops. Here is why inflation expectations matter so much more than the headline sentiment for silver specifically. The Federal Reserve does not just watch actual inflation, it watches what people expect inflation to be, because expectations are self-fulfilling. If workers expect higher inflation, they demand higher wages. If businesses expect higher inflation, they raise prices. The whole system can become inflationary simply because everyone expects it to be. The Fed's nightmare scenario right now is not just current inflation. It is inflation expectations becoming unanchored, meaning people start expecting not the 2% target but 4, 5, 6% inflation far into the future. When that happens, the Fed has to respond aggressively with rate hikes to break the expectation cycle, and aggressive rate hikes are the single most powerful force that can crush silver. So here is how Friday's Michigan number connects directly to silver. If the preliminary April reading shows inflation expectations increasing again, say moving from 3.8% toward 4 or higher, the market will interpret that as a signal that oil-driven inflation fears are becoming embedded in consumer psychology. The Fed will feel more pressure to hike core at minimum to hold rates higher for longer. The dollar gets support, treasury yields push higher, and silver faces renewed selling pressure toward that $67 support zone that has been the critical line all month. But here is where it gets genuinely interesting for silver bulls. The March survey was collected between February 17th and March 23rd. About two-thirds of respondents were interviewed after the US-Iran conflict started on February 28th. That means the 3.8% inflation expectation figure reflects the immediate shock of the war beginning, the initial panic, the gas price surge, the fear. The April preliminary will capture what happened after that initial shock. Two things have been competing since then. On one hand, oil has remained elevated, keeping inflation pressure alive. On the other hand, there have been ceasefire signals Trump hinted at willingness to end the war. Iran signaled negotiating flexibility in Geneva. If consumers interpreted those signals as meaning the oil shock is temporary, April inflation expectations could actually pull back, and a pullback in inflation expectations would be meaningfully silver bullish because it would signal that the Fed does not need to be as aggressive as markets currently fear. Subscribe right now and hit like if you want to keep getting this kind of precise breakdown of which specific numbers matter for silver and why. The mainstream financial press will cover the Michigan headline. I'm going to tell you which number inside it actually moves this market. Subscribe and bell. Let's finish this breakdown. There is also the 5-year inflation expectation number inside the Michigan survey. This is the longer-run view, what consumers think inflation will average over the next 5 years. In March, that came in at 3.2%. For context, before the pandemic, this number was consistently below 2.8%. The fact that 5-year expectations are holding at 3.2% tells the Fed that people still largely believe the current inflation spike is somewhat temporary. They are not pricing in permanent high inflation across the next 5 years. If that number stays below 3.5% or moves lower in April's reading, that gives the Fed cover to avoid aggressive hiking, which is silver supportive. If 5-year expectations start rising, if they move toward 3.5, 3.7, or higher, that is the signal that American consumers are starting to believe high inflation is structural rather than temporary, that terrifies the Fed. That would be the most overtly silver bearish outcome from Friday's data, not just short-term pressure. A signal that the Fed's whole approach needs to become more aggressive for longer. Watch that 5-year number specifically when the data drops Friday morning at 10 a.m. Eastern. Now let me connect the Michigan data to the rest of what has happened this week, because Friday's number does not exist in isolation. It lands after a week that already included a DP private payrolls on Tuesday, the FOMC minutes on Wednesday, and initial jobless claims and GDP revision on Thursday. By the time Friday's Michigan data arrives, the market will have processed a full week of economic signals, and the picture those signals paint together is going to determine whether silver's Friday reaction is a clean directional move or a chaotic, confused session. Here is what to watch for in that context. If by Friday morning the cumulative read from this week's data is that the economy is genuinely slowing, if jobless claims are rising, if GDP came in soft, if FOMC minutes revealed a Fed grappling with stagflation, then Friday's Michigan data becomes an important confirmation signal rather than a standalone catalyst. Weak consumer sentiment plus high inflation expectations in a context where the economy is already showing cracks tells the market that stagflation is real. That is an unusual but not impossible silver bullish scenario. Here is the logic in stagflation. The Fed cannot aggressively hike because the economy cannot withstand it. The dollar's rate advantage erodes, real yields stay low or go negative, and real assets, including silver, tend to be re-rated upward as the alternative to a currency that is being debased by a trapped central bank. This is essentially what happened in the 1970s when silver exploded higher alongside high inflation and economic weakness. On the other hand, if the week's data has painted a picture of economic resilience, if jobless claims stayed low, if GDP came in stronger than expected, if the FOMC minutes read as hawkish, then Friday's Michigan data becomes a potential final nail in silver's near-term coffin. Strong economy plus high inflation expectations means the Fed can hike without wrecking the economy. Full financial tightening, dollar surges, silver goes lower. The third possibility is the one that tends to produce the most confusing silver sessions: mixed signals, weak confidence but moderating inflation expectations, strong confidence but declining inflation expectations. Anything that creates genuine ambiguity about the Fed's direction typically produces a whipsaw session. Silver moves sharply one way in the 30 minutes after the data, then reverses, then settles somewhere unclear. In a whipsaw session, the cleanest trade is no trade at all. Watch the initial reaction without acting on it, then wait for the market to settle and see where silver closes relative to that $72 resistance line. Let me now give you the practical playbook for Friday morning. You do not need to be glued to a screen at 10 a.m. Eastern. You need to know what to check and what it means when you do check it. At 10 a.m. Eastern, when Michigan consumer sentiment drops, look for 3 specific numbers in this order. First, the 1-year inflation expectations. Below 3.5%, silver gets some relief. Above 4.0%, silver faces immediate selling pressure. Second, the headline sentiment index. Below 50 would be historic, near all-time lows, and would signal consumer economic panic that paradoxically could support silver as a safe haven even in a high inflation environment. Above 58 would be a surprise positive that could support risk assets and reduce safe haven demand. Third, the 5-year inflation expectations. Below 3.0% is outright silver bullish. Above 3.5% is the most overtly bear signal in the entire report. After the data drops, give it 20 to 30 minutes before making any judgments about the session direction. The initial reaction in silver is often noise, algorithmic traders firing on the headline number before analysts have read the full report. The real directional move tends to develop in the 30 to 60 minutes after release as the market digests all 3 numbers and puts them in context with the week's prior data. The level to watch on silver going into Friday is still $72, that downward trend line from January's all-time high. A Michigan reading that comes in with cooling inflation expectations could be the catalyst that finally pushes silver through that line convincingly. A Michigan reading with accelerating inflation expectations could be the catalyst that breaks silver below $70 and sends it toward the 67 support zone. And a mixed reading continues the range, with 72.74 holding as the magnetic zone until the next decisive catalyst arrives. Here is the honest bottom line for Friday. This is an important data point, but it is not a binary outcome that tells you definitively whether silver goes to $100 or $60. What it is one more piece of a mosaic that the market is assembling piece by piece to answer the fundamental question of 2026. Is the Fed trapped by stagflation, or does it have room to fight inflation aggressively? The Michigan inflation expectations data on Friday is a direct window into that question from the consumer's perspective, and the consumer's perspective matters enormously because consumer spending is 70% of the U.S. economy, and because the Fed's credibility in managing inflation expectations is central to its ability to do anything at all about the current environment. Watch Friday's 10 a.m. data with those 3 numbers in your head: 1-year expectations, headline index, 5-year expectations, in that order. Those 3 numbers will tell you more about silver's near-term direction than any single headline about oil or Iran or tariffs that drops the same morning. Drop a comment below right now. Tell me which specific component of Friday's Michigan data you think matters most for silver this week. Is it the headline confidence number, the 1-year inflation expectations, or the 5-year long-run view? I want to know how you are reading this week's setup. Every comment gets read and shapes what I cover next. And if you know someone who is watching silver and preparing for Friday's session, share this video with them right now. 2 seconds. The kind of breakdown that tells you not just what data is dropping, but exactly which number. Inside it moves the market. Hit share. I will be here Friday to break down the actual numbers the moment they drop.